Hi investors, welcome to SOIC. So in this podcast, we'll be discussing the legendary investor Howard Marks' memo, and we'll be applying it in the Indian context with a lot of case studies because that is how the real learning takes place. One thing is to be is to basically distribute wisdom, and the other thing is to actually talk about practical experiences, talking about using the examples of the Indian stocks. So the name of the memo was "I beg to differ," and this was again published by Mr. Howard Marks. And this memo was meant for Oak Tree clients, and he's been doing this for almost last 20 years almost. And these memos are a delight to read. You can also check his website, Oak Tree Clients. And just the name of the memo is very, very unique. I beg to differ. I beg to differ means that I beg to differ, that I have a different point of opinion as compared to the standard view of the public or the standard view of the herd. I've said this a lot of times that the standard valuation metric or the standard valuation multiple that all of us use has been price to earnings, right? And what is price to earnings? It is nothing but perception to earnings. So he's saying, I beg to differ to earnings ratio. That is what it means. That I beg to differ, that the perception about the quality of the earnings of the company is different. Perception about the growth of the earnings is different. This is what he means to say that I beg to differ upon earnings ratio of the company. That is what the basic purpose of this memo is, and we'll keep reading it as well. So in the first paragraph, he talks about that in many of the Nifty 50 companies for which it had been thought that no price was too high, did far worse, falling from peak PE ratios of 60 to 90 times to trough multiple in single digits. Thus, their devotees lost almost all of their monies in stock of companies that everyone knew were great. This was my first chance to see what can happen to assets that are on what I call the pedestal of popularity. So in 1969, the Nifty 50 bubble was formed in US. So there were these 50 large famous companies in US which got extremely famous, like the IBMs of the world, the McDonald's of the world, the Xerox of the world. And there was a saying as well that you can't be fired for buying IBM within the investment management industry. Now this is the exact saying that Howard Marks is telling us to go against. Because when it comes to price to earnings ratio or perception to earnings ratio, everyone knows it's a great company. The bright future for those companies is already priced in. So what will happen if any type of negative event happens, or if any type of negative macro shock happens? So this actually is true, and one of my friends has owned Shopify and Roku in the past, which is listed in US. And he used to swear by those companies because he used to think that Shopify is the challenger to Amazon's basically monopoly, and they'll sort of help the independent sellers, and they'll do something or something, and they'll basically get into logistics as well, and the valuation multiple is justified. I think it was at 40x price to sales multiple. And eventually what happened? The macroeconomic slowdown. And we saw that the stock price of Shopify, if I'm not mistaken, the stock price of Shopify has sort of fallen from the peak of $169 to $35 right now, which is like a drawdown of nearly 80%, right? Because you always pay up for consensus. If the multiples or if the earnings are discounting multiple years ahead into the future, so it means that the herd has already seen the positives of the company. It's very difficult to unearth something that might be not seen to the markets, and thus it becomes extremely risky to buy at those valuations. Again, moving on, so this is one of the things that he mentions in his memo, that if you seek superior investment results, you have to invest in things that others haven't flocked to and cost to be fully valued. In other words, you have to do something different. I quickly recognized that my strong performance basically resulted in my large part from precisely the fact that I was investing in securities that practically no one knew about, cared about, or deemed desirable. So over here, I'll just give you an example of one of the steel wire companies. Like I've spoken in our last podcast, which was done in September 2021. So in that podcast, I spoke about how one of the companies is going through a cycle of deleveraging, and like this steel wire leader company has actually sold off its steel plant, and the dispute between the brothers has been resolved, and one of the brothers has actually left the company, and the value added product mix is going to increase in the company. And I think stock is like almost has been a one bagger from there, like in a flat market, in an environment where small and mid cap indices have been like 15 to 20% down, and EBITDA margins have actually expanded for the company or have been like in the flat range, and the company is actually doing capex in the value added product range. But the most important thing to notice over here is that the P multiple for the company from like a 10 times P multiple has now expanded to almost 17 times P multiple. Now this is what ends up happening is that whenever there's disgust around an idea, like I discussed this idea, believe me, with a lot of my good investing friends, and they were disgusted at the idea. So whenever there's disgust around the idea, then you know that the perception is literally beyond shit right now in the company. And that is when, if there is even little surprise in the earnings, or even if there's little surprise in the perception that the company announces a dividend, or if there is a capex announcement that is into high value margin products, then the perception re-rate starts to happen. For this company, the PBT or the EBITDA margins, like since September 2021, that is from Q2 of FY22, the EBITDA has grown from 85 crores to 107 crores. And the interest cost has fallen from 12 crores to 7 crores. So let's just also look at the borrowings. Borrowings has fallen from 530 crores to 411 crores YOY. This borrowing number used to be 3,500 crores in 2019 and 4,000 crores in 2018. So this just implies that your willingness to look stupid and just to allocate even if 3 or 3.5% of capital in such an idea in a PF level basis. Now again, I'm not intentionally naming the stock, but just as an idea, if you do such things in the Indian context as well, when the perception or basically when the stock idea is ignored, or whenever the perception is changing, or whenever the fundamental triggers are there, this is how the real investing success comes. And we'll discuss more as well, right? Now, he talks about the essential difference in his process. So he wrote a memo, Dare to be Great, and in the memo he discussed the process for investing. So one is conventional behavior. Conventional behavior is buying all the high PE companies, hugging the index, buying the index hugger companies. And in this, if your outcomes are favorable, then you'll get average to good results. Basically, you'll beat the index by 1 or 1 odd percent, 1 or 1.5% here or there. If the outcome is unfavorable, then if you're basically investing in a large cap mutual fund, or if you're giving your money to some mutual fund manager, or basically even if you're doing it yourself, and if the outcome is unfavorable, then you'll get average to bad results. Because in this scenario, what will happen? The P might derate of those companies. Like it has happened with the Dabur, like it has happened with the Marico, like it has happened with the Britannia as well. Like these companies used to be darlings of the market once, but like these companies have failed to like generate even nifty level returns in last 3-4 years. So that ends up happening in unfavorable outcomes. In unconventional behavior, where you're going to buy companies which are not so known, which are not so popular, and where some type of variant perception or where some type of essential difference exists, then if the outcome is favorable, then your returns will be way, way above average. If the outcomes are unfavorable, then your returns will be way, way below average as well. So the thing is that if you want to land in this above average category, you have to think about yourself as a casino. And a casino that can make 20 to 25 such bets. That a casino who takes 20 to 25 such bets, and even if he goes wrong in 5 or 6 of those bets, and even if he succeeds massively in 7 or 8 of those bets, he's home and dry. That is how you have to think about these possibilities and probabilities. Sometimes you'll go wrong on a factor. And one of the factors like I personally went wrong in was, I think I bought 2 of those companies in pharmaceutical sector. But one thing which saved me, or which sort of helped me not to make negative returns, was my ability to maintain my selling discipline. That I was objective enough to sell when the facts went wrong, when the margins started compressing, gross margins went to trash, and those companies like business performance deteriorated really, really sharply. Thus, going forward, another point that he mentions in the letter is that you can't take the same actions as everyone else and expect to outperform. These are again words of wisdom, that you can't be like everyone else and end up outperforming. Just as an example, now there is one of the fluorination companies. Like I've been tracking and like personally been like owning the company for almost last like 2.5, 3 years now. But problem is that now again it's entering into that territory where a lot of people have seen the value, where the basically like contracts are confirmed, everything is confirmed, and re-rate has already happened before the earnings come. Now over here, what is the risk if the earnings don't come? And how is that risky? That no analyst on the street currently is correctly forecasting the depreciation of the company, that how much the depreciation rate could be in the future. That is where the variant perception on being objective enough to sort of take a contra call on the stock exists. That maybe the sales grow, the EBITDA grows, but the bottom line doesn't grow because your depreciation spend increases rapidly. These are just ways of thinking that if the multiple is high, if the value is seen, then what is it that remains unseen? Then what is it that the market is not able to see that you are able to see? And that is how you have to think about I beg to differ in this memo of Howard Marks. Again, one of the things is that he says that on average, all investors will do average. If you're happy doing average, you can simply invest in broad swath of assets in questions, buying some of each in proportion to its representation, its relevant universe or index. You are guaranteed average performance. If you want to be above average, you have to depart from consensus behavior. In other words, you have to do something different. So basically, if you want to do something average, if you want to be average, so a dumb money ceases to be dumb when it accepts its own limitations. So just go and invest in an index fund. That is the simplest thing to do if you do not have time for the markets, if you can't devote time for active investing. Simplest thing to do is to go and invest in an index fund. People think that they'll do some price volume action trading, will get ideas from there. Believe me, that is not a sustainable way to do it in the long term. Because what will end up happening is that once something breaks down or once like the price is 2-3% down, your conviction is shaken out because you haven't read the business at all. So that won't help you either. What will really help you is a sound understanding of fundamentals, and then maybe you can mix such things up with that. But if you think you can't really devote the time, then be the average, go for an index, and that is the best thing to do. Now, every active bet placed in pursuit of above average return carries with itself the risk of below average returns. You can't hope to earn above average returns if you don't place active bets. But if your active bets are wrong, your returns will be below average. If you hope to distinguish yourself in terms of performance, you have to depart from the pack. But have departed. The difference will only be positive if your choice of strategies and tactics is correct and you're able to execute better. Now here the difference arises is that even if you're taking these contra calls or if your portfolio is differentiated from the market, it could still be that you're wrong because your thinking or thought process about that company is wrong. Now let me give you an example about one of the IT companies which is heavily dependent upon UK for its revenues. It was very, very visible like not so long back that this company is like a beneficiary of a favorable demand environment, which a lot of IT companies were. And this company is highly dependent upon government for its revenues, like primarily revenues coming from B2G. And like last, when such type of uncertainty happened in the business was basically thrashed to almost a 6 or 7 times P multiple. This happened last in 2018-2019. So whenever you're buying a business at a peak demand scenario, the P multiple might optically look cheap, but what happens if the earnings evaporate? Again, underperformance and several years of headwinds in the stock price. Similarly, one of the CLG cos, right? So again, a similar problem or a similar error, right? So this time yours truly made the error. Again, similar error, peak demand, peak pricing environment, no travel expenses, margins are high. Again, you're getting in a truly hot environment in a stock, right? Maybe you manage your risk through allocations in such bets. You start by sizing it at 1-2% initially, and then you see how it plays out. But then if you see that some type of headwinds are coming, if the management itself is saying that we will not be able to grow, or if some type of headwinds are emerging, you can always sidestep the thing initially. So again, this is just a way of thinking that even if you're different from the market, your returns might not converge with the market, or your returns might be inferior if you get into an environment where the demand is hot, where the margins are hot, where expenses are like artificially low. Similarly, what happened in agrochemical companies recently, right? So again, because I've been so burnt in the past by my own experiences. So by being burnt so many times, you start learning these things. This is how experience counts in investing. Going forward, right? So again, this is one of the things that he mentions in the memo, is the importance of second order thinking. Second order thinking is nothing but millions of people are competing for each dollar of investment gain. Who'll get it? The person who's a step ahead. In some pursuits, getting up to the front of the pack means more schooling, more time in the gym or the library, better nutrition, more perspiration, greater stamina or better equipment. But in investing, where these things count for less, it calls for more perspective thinking at what I call the second level thinking. What a second level thinker does is he thinks about what is the range of likely future outcomes. What outcomes do I think will occur? What's the probability if I'm right? What does the consensus think? How does my expectation differ from consensus? How does the current price for the asset basically comport with the consensus view of the future and with mine? Is the consensus psychology that's incorporated in the price too bullish or bearish? What will happen to the asset's price if the consensus turns out to be right, and what if I'm right? First level thinkers look for simple formulas and easy answers. Second level thinkers know that success in investing is the antithesis of simple. And this is what Charlie Munger keeps on saying again and again. Investing seems to be simple, but it's not easy. And whosoever think it's easy is plain stupid, because it's not supposed to be easy. So basically what even Howard Marks in this memo is telling us, that second order thinking is asking us to think like in terms of what is basically asking us to think in terms of what will happen if this happens, what will happen if that will happen, what will happen if that happens. So let me give you an example. So one of the large API companies, right, reported results in Q4 FY22, and the stock fell massively after the results. No one was able to fathom the reason why, but again, simple reason for the stock correction was that there was a lot of revenues for COVID drug in their quarterly revenues, and X of that, the base business had degrown by 25-30%. This is why the stock price also basically corrected a lot. Second order thinking is, suppose just as an idea, so like this, there is a business by the name of Balkrishna Industries. Now Balkrishna Industries is actually a company which 50 to 60% of their supply goes to the agri tires, right? So they supply off the highway tires for agriculture in Europe and US. Now agriculture is a cyclical thing, right? So because it depends upon farm grade prices, it also depends upon how the basically how the environment or how the demand has been. So again, whenever the farm gate prices decline, or whenever the decline for agri tires and stuff declines, the company is able to sort of sustain its volumes and sort of be able to degrow its volume by 1 or 2%, whereas industry degrows by 10-15%. But at that point of time, you can pick up any analyst report and they'll just call it a completely cyclical company. And that is the point of time when the PE ratios of the company will ideally fall to 14 times, 15 times, 18 times, 16 times, 20 times, which is like the trough or mean PE ratio for the company. Now a second order thinker will think that this is not the permanent demand environment. This environment won't remain forever. So what if this demand environment changes? That is when you go back to 8, 10, 12% volume growth. And because the business has so high operating leverage, you again get 20-25% PAT growth. So this is the type of thinking that you have to do if you have to truly make extraordinary returns. And then you get the PE re-rating along with earnings growth. Another example that we can sort of discuss is that of one of the ice cream businesses which is listed in the markets. Now in this business, what has happened is that the geographical mix has changed, right? Because the exports to North America have been growing at a very fast clip. Now a lot of people missed this when they were sort of viewing the business, because exports to North America is again a higher margin business, and you can just X out the geographical split and you can see that North American business is growing at a very fast clip. And this is how simply such a business could have been caught. Again, this is just a way of thinking. This is just like, suppose even if you go wrong in some of these ideas, but if your portfolio allocation approach is right, in some of them you'll go wrong, in some of them you go right, then you still end up making money, because on a portfolio level your expected valuation is positive. Now again, just going forward, so like more case studies if we just talk about. So again, there is one of the just discussing this case study of recently one of the recent IPOs in retail sector. I think they IPO'd somewhere in 2018, and the company is into women retail, like women clothing and stuff. And basically company was badly impacted by the COVID crisis, and now the company is again opening a lot of stores. Now a second level thinker will go and see what was the peak profitability for this company in 2018-19 when it wasn't impacted by COVID. And then he'll compare the valuation since then, and then he'll see what number of stores is this company opening. And if he is right, what type of payoff does he stand to make? Because if he is thinking through that, then the stock is available at 2022 XP on 2019 basis without even baking in growth. This is what second level thinking actually seems like. Another example is that of a little paints company, right? This one is based out of Delhi only. That what if this company has actually created a niche in the wooden PU market? And what if they're able to grow the revenues? What if they're just able to grow within the markets they are present in? What can happen to the revenues? Now, second order thinking will call for carefully getting the sub-segmentation of the category right, and carefully assessing that whether this category can be penetrated by the giants or not. This is what second order thinking will call in such businesses. Now, this is how you can sort of think about businesses. Now, what is there is as well is that the more you go into such businesses, there is also a risk that you can be wrong. But one of the things that you have to accept is that if you think that you're wrong, then you have to maintain a selling discipline. That you have to have the thesis and antithesis pointers with yourself. That what is your thesis pointer and what is your antithesis pointers. And if the antithesis starts outweighing the thesis, that is the moment you objectively maintain your selling discipline. No matter who runs the company, no matter if you love the stock, you just objectively go and sell it. That is what the second level thinking calls. That is what is like maintaining the objectivity of selling and maximizing the upside of being a variant perception investor. This is what you have to do. Like, you have to be uncomfortable. These ideas are idiosyncratic, as he mentions in his letter. And this is what he also mentions. That it's preferable to buy things that most people hate and sell things that most people love. Such behavior is by definition highly idiosyncratic. Uncomfortable. The mass of investors take positions they take for reasons they find convincing. We witness the same developments they do and are impacted by the same news. Yet, we realize that if we want to be above average, our reactions to those inputs and thus our behavior should in many instances be different than those from that of others. Regardless of the reasons, if millions of investors are doing the same, A, it may be quite comfortable to do B. Because if millions of investors are herded in one segment of the room, it will be very difficult for you to stand in the other segment. This reminds me of another idea that is in the education publishing business, right? So that idea is in the education publishing business. And again, some of these businesses since the IPO are down by like almost 70-80%. But maybe the IPO valuations were too damn high. But now after like last 2 years, I think stocks have been again moving back up, but businesses have been improving. Why so? Because there is a high degree of chances that national curriculum framework gets implemented. If the NCF gets implemented, what ends up happening is that the second-hand markets gets destroyed. And if the second-hand market for books is destroyed, then second-hand market for books is almost 2-3x the size of first-hand market for books. And this is how the publishers make like absurd money for 2-3 years. Now, this is what a second-order thinker will be doing today. This is what deep value investing or value investing actually looks like. And this is how you have to think about idiosyncratic ideas. Idiosyncratic ideas also work in selling. Like if you think the company has been re-rated to too high a valuation, you also have to think that what will sort of be the next thing in this company which can give me even higher returns from here. What will not lead to market returns or below market returns from these multiples? It has happened in that energy exchange, which like I was thankfully able to maintain the selling discipline. It happened in the animal API co, where I didn't maintain the selling discipline, like almost became a 1.3, 1.4 bagger, but had to sell it almost at cost or like some type of like loss as well, because I didn't maintain the selling discipline. Whenever the fundamental thesis deteriorates in a business or the valuation just goes absurd, and if the business is not able to perform in line, then that is the time you say goodbye to the business. Similar to the bromine business, right? You just don't see a chemical business at 110 or 120 XP multiples. It's just absurd, because these are B2B businesses with low cash conversion ratios, and you just like if you're doing this variant perception investing, equally for buying reasons and equally for selling reasons, you have to be very, very objective. So this is what Howard Marks teaches us in his new memo, and like few of the concluding lines, what he tells us, that if everyone else is focusing on something that doesn't matter and ignoring the thing that does, investors can profitably diverge from the pack by blocking out short-term concerns and maintaining a laser focus on long-term capital deployment. Basically, if there are changes that are happening which others are not noticing right now, but you are noticing right now, so then you should just block out the noise and trust your own gut feeling and your own opinions more as compared to others. And you just need to leverage time and just do time arbitrage and just sit in the business for a long time, and then you see the results eventually. This has happened in an industrial gear company as well, right, where people saw that the material and handling business will turn around, and finally the business has turned around. And after turning around, the business has just like, I think the like profits of the company itself has like grown from 58 crores to 156 crores. Like the stock price might be like almost 2-3 bagger now, but now the brokerages are coming out with like target prices and stuff, right? But these ideas are found when you have to be lonely, you have to understand the businesses, you have to be fundamentally sound in the earnings analysis of the business, and you need to develop a variant perception, and you need to respect valuations at the end of the day. This is simply what the memo means, and this is what Howard Marks means, that I beg to differ to earnings ratio, that he begs to differ that the earnings or the quality of the earnings of this company could be vastly different than what the market is seeing. Thank you so much for listening to the podcast. Hope you enjoyed learning with SOIC. Thank you so much. Hope to see you in the next podcast of SOIC. Jai Hind.